In this module, we cover Chapter 6, and it's over financing. There are 7 possible questions on your state licensing exam. So let's get started. Number 1, theories of mortgage law. First of all, let's discuss that A, lien theory. That's what we deal with in our state. The mortgage is viewed as a lien on the property in many states. When you buy property, you will get a lien. And the lien theory means that when you have a lien on the property, you still own it. You still completely own the property. There's simply a lien, which goes back to a few chapters ago. Remember, that's called an encumbrance. That's called a voluntary encumbrance. We get a mortgage, we get a lien, and that's what lien theory is, that we own the property, but somebody else has a lien on the property. Go to Roman numeral 2, a mortgage loan. If you've bought a house and you had a lender, mortgage broker, these are three or four things that you had to deal with. A is mortgage origination. There are pretty much 3 or 4 key ingredients. A mortgage origination, and I'll show it here on the board, is a cost to originate a loan. I've got a couple samples in there. Sometimes there's associated costs. Lenders, it's totally up to them to charge these costs or not. So that's why many people shop around. But you could see this an origination of maybe 0.5% or 1%. That's to originate the loan. That's one of the costs that they might have. There's also something called discount points, and this is usually reflective of the interest rate. So you make application. If you would like, you can pay a higher amount and get a lower interest rate. They call it, sometimes it's referred to as a buy down. Why would you want to buy down or pay more to get a loan? Well, if that reduces the interest rate and you're going to be in that property for a number of years, that might end up saving you thousands of dollars over this entire 30-year term. So it might cost you $2,000 more up front, but if you're going to be there for 10 years, the savings in interest might be $10,000. So that's the rationale behind why you would pay more down, or rather pay a higher, put more into it to get a lower interest rate. First thing, A, mortgage and origination. We did that. Go to, and the second portion of that sentence is a uniform residential loan application. They call it a 1003. When you apply for the loan, you fill out a document. It's called the 1003. B, the mortgage. We know what that is. Document by which the mortgagor, the borrower, places a lien on the property in favor of the mortgagee, which is the lender, as security for the debt. The mortgage is kind of the set of rules. It's this thick, multi-page long, and I had a closer actually say, this is the document that says if you don't pay, you don't stay. So it's all the things that you have to do in order to keep current. They'll even have things in there about acceleration clauses and other different clauses that show if you're late on your payment or you don't pay. So there's all those kind of things in there. Then the last on C is a note. That is the promise to repay the debt. So you have these 2 documents sandwiched together that you're signing at the closing table. The mortgage is all the rules and regulations of the loan. The promise to pay is the note, and that's just pretty much as a simplified document, or it's complex, but it's pretty much says, I will pay this amount to you over this number of years for this interest rate. So it's a document that says, I promise to pay this loan back. Go to 4, types of loans. If you've received a loan probably in the last 30 to 40 years, A would probably be the one that you used. There are different, you can do graduated payments, you can do adjustable rates. This seems to be the most common. So that's A, amortized loan or a fixed payment. Your payment will be $1,000 at 5% interest for 30 years. That's what A is. Go to the next page, top of page 70B, Graduated payment mortgage. That allows for smaller payments in the early years, increasing your payments over into the later years, and then which ends up causing you a negative amortization by adding the early years, and you defer to the principal. I know it sounds complicated. That's why it's not a very, from my experience, it's not something that I see a lot in the marketplace. C, straight or interest loan, allows for payments of interest only with a lump sum at maturity. D, balloon payment. Envision a big balloon where you pay on it maybe X number of years, and at the end of that number of years, all the rest is due up front. So you think this big, gigantic balloon, that's due and payable at that time period. We go to number 5, mortgage provision. Now let me stop for just a second. We discussed different types of loans. And within your payment that you're paying every month, most likely you're going to see this, or this is what you're engaging in. You're paying PITI, principal, interest, taxes, and insurance. So you pay your $1,000 a month, $2,000 a month. More than likely you've got a principal, interest, taxes, and insurance all in that same payment amount. Here's a timeline. And the timeline shows if you get a 30-year note, your first year, most of these first initial years, you're paying mostly interest. Then after about the 15-year mark, maybe sooner, the principal starts getting reduced all the way down to 30 years. So when you have a 30-year loan, the interest and the principals, you're kind of front-loaded with interest, and then you start knocking it down. One of the reasons why people prefer 15-year notes. It's a slightly higher payment, but you get your house paid off and you're building up equity a lot quicker. So I just kind of use that as a timeline to give you an understanding of how some of that works. Okay, 5 mortgage provisions. A, the acceleration clause. We discussed that mortgage. These are things in there that if maybe you don't pay, here's what happens. So that's what all of these A through F are. 1 is an acceleration clause. If you default, they can ask for the entire note due and payable. You can maybe just be defaulted by 2 or 3 months. Well, they have a right based on this clause to say, okay, I know you're only late 2 or 3 or 4 or 5 months, but we need that to be completely collected right now. The next, go to C, a defeasance clause. When you pay your loan off, we'll give you a release. That's what a defeasance clause is. So you pay your loan off, they're supposed to give you a release of lien. D, and that's why I try to paraphrase these because it's easier to understand. Alienation clause. You sell it, you need to pay us. You need to pay the lender. So you can't sell your property and then just say, oops, I forgot to pay you off. That most likely wouldn't happen because the process, you go through title attorneys and closings, and they're responsible for making sure things are paid off. But that's what the alienation is, the alienation is. You sell it, you have to pay it off. E is buying subject to, if the property is sold subject to the mortgage. There's a couple variations you're going to see in the marketplace. There's a subject to and there's also an assumption. Don't get too caught up in what those are. But an assumption is essentially this. You can do it qualified or you can do it unqualified or non-qualified assumption. A qualified assumption is that somebody wants to assume your loan. Maybe the interest rate is attractive. They assume your loan. A non-qualifying is that they don't have to go through the credit and checks and do all that. They just come in, assume your loan, but a qualifying is that they have to go through the process of applying for that loan to assume it, in other words. So when you let someone just assume your loan and it's non-qualifying, you're still on the hook. Okay, they have responsibility and then you have some responsibility. But if you have them qualify for that loan, you're off the hook. You can go on your merry way and let them take it over. So that's the distinction. Number 6, Roman numeral 6. B, non-judicial foreclosure. If you don't pay and they go through a foreclosure process, no 1, 2, primarily 1 and 2. The mortgage generally must include a power of sale clause. And then 2, a notice of default must be recorded and public sale advertised in the newspaper. And then you should know 3. The property is sold at a public sale to the highest bidder. So that's the basic foreclosure process. I think lenders generally like to work with people. No one likes the foreclosure process. The lenders don't like it. The public doesn't like it. We don't want to go through those things because it causes a lot of heartache and problems. So, typically they'll try to work with you. If they can't work it out, they go through this power of sale clause that says we can take it back, go to share the auction and sell your property and then receive the funds that way. There's something D called deed in lieu of foreclosure. You can go that route. Contact your mortgagor. I'm not giving advice. I'm just saying in this situation, a person can go talk to their lender, request a deed in lieu, which just says, look, I can't make my payments. Would you work it out? Here's my house. Here's my property. I can't work it out. Can you work with me? And that's what the deed in lieu of foreclosure is. A short sale, you need to know what that short sale is. In other words, you owe $90,000, or maybe you owe $100,000 for your property. You've got a contract, and the only thing you can get is $90,000. There's a $10,000 quote short amount. So you owe $100,000. You get a contract that says $90,000. You go to the lender and say, I can pay the $90,000, close on it, give you this amount. Would you accept a short sale? They say yes or no. You have $10,000 that you should have owed, or you still owe to the lender. Well, they can actually say, okay, fine, that's okay, not make you pay it. Or they can go G, which is deficiency judgment. So go to 71G. If the property is sold and the proceeds are insufficient to pay the mortgage, the difference is the deficiency. The lender usually can sue the original borrower for the difference. Process of deficiency judgment. So what they do is they say, look, we aren't going to let you off the hook for this extra $10,000. We'll just detach it, and you have to pay us. So at some point in time in the future, you still have to pay us this $10,000. We'll let you out of the house. You can go on your merry way, but you still owe us $10,000. That's a deficiency judgment. Okay. I'm going to go through the financing portion. I'm going to go through the primary financing plans that are up here on the board. These are the characteristics you need to know. I know this gets pretty lengthy, but I'm just going to hit the 4 or 5 that are really important for all these. So you need to know the characteristics of these primary financing plans. The first one is conventional. Now I've got some examples up here, and they're just simply examples. Conventional loan, and I should put this here, private. So include that, and this is government, and this is government. When you go conventional, it's to a private entity. It's not government. It's not a government-backed, or rather not a government-type program or loan. So a conventional is private. They usually require higher down payments. This one, I use the example of 80%, and when you see the term LTV, that's loan to value. So if someone gets an 80% loan to value property, what is their down payment? 20%. Same way with an FHA. And these are just for purposes of instruction, they're just kind of rounding up or down. FHA, usually a lower down payment, 3 to 5% down payment, which gives you a 95% loan to value. VA, government-backed, they'll give you 100% loan to value. What you need to know about these is conventional. If you put down 20%, they don't have any PMI insurance. And when you get a loan, they want to be insured in case you default. So if you go FHA and conventional, there's going to be you're going to pay insurance. Conventional says if you put 20% down, you got, quote, some skin in the game. We aren't going to worry about it, so you don't owe insurance. We aren't going to make you pay insurance. Any higher than that, you're going to owe some insurance. And they call it private mortgage insurance. FHA, which is the government-backed program, calls it mortgage insurance premium. So MIP, PMI, they're just different. Same thing, only different categories. And then VA has some other associated costs to it. But these are your LTVs. About private, government, PMI, no PMI. All right. And this is what we just, we highlighted most of these characteristics on conventional. Okay, what you want, there's one more thing on here that says B, go to B4. Mortgage property must be appraised by an FHA approved appraiser. So whenever you get an FHA loan, they require an FHA certified appraiser, and they have these certain standards that it must meet. So FHA, whenever you purchase property, they want to make sure it meets a certain standard. That's to maintain the property value and to maintain the areas. So they have a standard you have to meet, and that's why they require that. Okay, go to page 72. C3. When they use the term DVA, DVA guaranteed home loans for eligible veterans or eligible dependents. Okay, this is also something you need to know. FHA insures loans. You don't get a loan from FHA. You get a loan from ABC Bank. It's backed by FHA, which provides insurance to the lender. So FHA is the program. The program comes from any lender you want to go to that's approved. So it could be ABC, CBA, whatever it is. They'll fund it. The FHA will insure it. So here's what you need to know. FHA insures, VA guarantees. So VA, they call it guaranteeing the loan versus insuring it. So they guarantee the loan, or they guarantee the lender for their veteran. So those are things you need to remember. And it's easy to remember to say FHA insures, VA guarantees. So know those characteristics. Go to D on page 72. Rural Development and Farm Agency. 2, Farm Service Agency makes and guarantees loans to farmers and ranchers. There's this also this group that's called Rural Development and Farm Agency, and they are a certain entity that understands farms, ranches, and implements and how all that works. And that's the group that you need to go to initiate a rural development or a farm loan. Okay, go to the next page, 73. 73. 5, as property values rise and the loan-to-value ratio becomes 80% or less, the PMI insurance may be dropped. Okay, that's with that private insurance on the rural economic development programs too. Go to H, a blanket mortgage. So envision a blanket. You have 5 different properties, and you have a mortgage that covers all of them. So that's what a blanket mortgage is. So you envision this blanket covering all of your properties. That's what a mortgage or blanket mortgage is. Construction loans, K, generally short-term or interim loans to finance construction of improvement. They are for, you go in, you get a loan, it's 6 months to a year, you finish the property, they give you draws to finish the property, then the builder turns around and sells it. The new buyer will either get permanent financing from that particular lender or they'll go out and get permanent financing. So construction loans are short-term. ARMs, N. You need to know the characteristics of an ARM. It's really pretty easy. Number 1, contains interest rate provision related to a selected index. ARMs are adjustable. Number 3, can be converted to fixed rate mortgages at some point in time. You can refinance them. But what they do is they go up and down based on an index. They have caps associated with them sometime, or I guess all the time, that it can, if the interest rate in a particular year goes up 6%, they cap it out at a 1% maybe over 1 year, and then to a lifetime cap of no more than a certain amount. So you have these caps. So it protects you in case the interest rate, just for whatever reason, skyrockets. Okay. Q, buy downs. We discussed this earlier. Don't spend a whole lot of time on this. Temporary or permanent. In other words, the temporary buy down is I'm just buying it down for maybe the first year, and then it's going to rise back up. Permanent buy down is I'm buying my interest rate for the full 30-year term. So the difference is that I'm buying it down just for a certain amount of time versus I'm doing a permanent buy down, which would be over the course of the entire 30-year or 15-year note. Go to 9, sources of real estate financing. Top of page 75, commercial banks. Well, the first one's savings and loan, A. B is commercial banks. Commercial banks, number one, prefer short term. Those are like what we discussed in construction type loans. Go to E, the mortgage banking company. One originates loans with their own money and money belonging to other institutions from other sources. So you have mortgage banking companies. It's normally just your bank that provides mortgages. And then you go to F, which is a mortgage broker. So a mortgage banking company, not only can you write checks from it, and they provide savings accounts, they provide loans. They're kind of this full service type bank. That's where you can get a loan. Or you can go to a mortgage broker. A mortgage broker has what they call wholesale products. So if you go to a mortgage broker and say, I want a loan, they might turn around and say, okay, I've got 5 different lenders that I can get you a loan. I'm going to package up a product or a loan that's just for you, and I might use another lender, but what I do is I put the lender and the consumer together, and the way that I get paid is a fee based on that. Okay, so mortgage brokers originate loans for other lenders, but they don't service them. For the most part, it's other people's money. 10, secondary mortgage market. What you need to know about the secondary mortgage market is it provides liquidity in the buying and selling of mortgages. If we didn't have a secondary mortgage market, buying up or gathering up all these loans, then what would happen is everything would come to a grinding halt. Because once the lender gives out all their money in loans, they kind of get stuck. So if they can't package these loans and sell them off to the secondary money market, then their reserve requirements are way too high, so they can't loan any more money. So the reason it provides liquidity to the market is because it keeps this flow of money going. Probably heard a couple of these. The primary ones are, see where it says major warehousing agencies. These are the top 2. Federal National Mortgage Association, Fannie Mae. And then 2, Government National Mortgage Association, Ginnie Mae. Fannie Mae is a pseudo-private government-backed program. Been in the newspaper lately, in the news lately about Fannie Mae and mortgages and what their primary purpose is. But anyway, they're part of the process of gathering up all these loans and servicing those loans. Go to 11 on page 76. Mortgage fraud. The bottom line is if the lenders are engaging in some kind of fraud, or the realtors are engaging in some kind of fraud, if you know about it as a licensee, you can't just say, well, I know about it, but I'll just won't listen to it. Or I'll just turn the other cheek and not say anything about it. Bottom line is if you hear about it and you're in any involvement, then you're going to be in trouble for fraud also. So you can't just turn a blind eye to anything that you know of. You can't participate in any fraudulent documents in any way. You're going to be responsible for those. Go to the last. It says it's 13, closing statements. You don't have to be a closing statement expert. You just do have to understand that there's certain procedures that you have to follow. Go to the next page, top of 77, E. Closing statement procedures generally reflect local custom as well as state and federal laws, for example, RESPA. We're going to talk about RESPA, but RESPA is a Real Estate Settlement Procedures Act. And what they do is they make sure that there's Everything is done in a professional manner. There's also not people paying each other for utilizing each other's services. So that's the governing agency that makes sure that we aren't, paying, hey, look, if you give me a whole bunch of loans, I'll give you a lot of money. You can't do that. Other important terms, and then we'll be done with this chapter. B, balloon payment. Discussed that earlier, know that. C is equity. The more principal you pay off in your home, the more equity you build. Now, there's another way to have equity too, and that's if your price appreciation of your property. That's also building equity. So if you're paying it down, price increases in your value of your home or your property, then you're building up equity, and that's what equity is. Usury. Usury is charging a rate of interest in excess of the maximum rate allowed by state law. So the state law has a fixed amount that you can't charge anybody over that. If you do, it's called usury. F, seller's financing. The seller of real estate provides financing for the sale by taking back a secured note. If you have your house, you've paid it all off, and you decide to sell it, you could have that person just owe you a monthly payment, which means seller financing. So it works on ones that homes have been paid off completely, and they just pay you a certain amount. You become essentially the bank, and they pay you off over a number of years. The last one, K, is discount points, and we discussed that, discount points that you can pay up front. Some of them are charged, some of them you can buy them down, buy your loan down. And there's an example of discount points in K also. Well, that concludes chapter 6.